So, due to limitations on YouTube, I'm cutting this presentation in two. This is part two and a continuation of the previous presentation. So, after the production budget, we can move into the direct materials budget. It uses the output of the production budget here. These numbers here, 55 to 76,000 for the 4 quarters. Then we calculate the amount of materials required. And then we can calculate how much is purchased, the purchasing requirements, then multiply by the cost per unit gives us the direct materials cost. Now, we're using the assumption 2 kilograms of raw material are needed for each unit. So then we have the 110,000 for the 55,000 units that are being produced. We have 11,000 kilograms as our ending inventory, that's as the projected ending inventory for Q1. 10% is the needs for the next quarter. So we want to have a beginning inventory, which is 10% of the direct material needs for the next quarter. So we need 156,000. That means we want to have the ending inventory of 15,600. Similarly, 176,000, we want 17,600. 152,000, 15,200. Now with 60,000 units, we can calculate that the ending inventory that we want to have is going to be 12,000. Moving on to the direct materials. In the payments, we are making assumptions here as well. Okay, the accounts payable balance in the beginning we have is 96,900. And then this is going to follow a similar structure to the accounts receivable side, where we see the amount of purchases required, which came from our direct materials purchases budget, just the last one. And we are assuming across the horizontal axis the times that we'll be making the payments. As you can see here, 50% of any quarter's purchases will be paid in the same quarter, and then 50% will be followed and paid in the next quarter. So as you can see, 171,900, we've got half of it here and half of it there. We can calculate therefore also the ending because accounts payable, because in the fourth quarter of the 223,000, we're going to pay half of that in the fourth quarter and half we will pay at the end or after the end of that year. So 111,600 will still be open as let's say, accounts payable at the end of the year. The direct labor budget is also based on the production levels. So we begin here with the production budget across the top. And then we have our assumption on the required direct labor hours needed per unit produced. That tells us how much the direct labor is that we need. And then we have a cost per direct labor hour, and that gives us the entire cost for the budget. Now, this can sometimes be more complicated if we have, for example, a certain minimum amount of direct labor hours because we have permanent employees that we're not going to pay them less than a certain number of hours. We may also have some overtime issues as well. But this is the simple version of a direct labor budget. Now, as we come to the manufacturing overhead budget, we started before doing this by having an estimate of the total amount of manufacturing overhead, and we have also an assumption on what would the cost driver be. So in other words, what's the basis upon which we are distributing those overhead costs. In this example here, we have direct labor cost. Other examples, other situations may include direct labor hours or machine hours or a combination of things. But in this example, we have direct labor cost. So we determine the predetermined overhead rate as 1.5 times the labor costs, and the fixed predetermined overhead rate was based on the total fixed overhead of 800,000. So we take the 800,000 divided by the 742,500 in direct labor costs, and that gives us 1.077 or 107.7% of labor costs. So calculating it that way, we have our variable manufacturing overhead here, and we have our fixed manufacturing overhead that gives us our total. And that's the total overhead that goes into our income statement. We also have to consider the depreciation, which is added back to calculate the cash disbursements that goes into our cash budget. Now, sales, general, and administrative expenses budget, we break it down into two in this case, variable and fixed SG&A expenses. Here, it's connected to sales. So here, the top line is the sales number in units and in dollars. We have then a variable expense as a percentage of the sales dollars, and that tells us what our variable sales expenses are. Then we move on into fixed expenses, and there we have salaries, advertising, depreciation, and other. And that gives us our total fixed expenses for the total sales, general, and administrative expenses. Now, again, here we have a depreciation, so we're going to add that back to calculate the cash disbursements, which is the bottom line here. Now, the cost of goods sold calculation is using the direct materials amount, direct labor, the variable overheads. That's with the 1.5 times the 2.5 direct labor costs, and the fixed overheads. Here you see the 107.7% of the 2.5 labor costs. So that gives us a unit cost of 11.94 that we can use to calculate cost of goods sold, and of course the ending inventory as well. So here we have the number of sales in units. We multiply by the cost of goods sold per unit, and that gives us our cost of goods sold. And the value of the ending inventory is going to be this 12,000 units that we have as ending finished goods inventory times 11.94. That gives us our ending inventory value. Just want to point out at this point in time that there's a slight change due to rounding, that you'll see a slightly different number in the balance sheet. But that's just because of the fraction of pennies on the per unit cost. So the cash disbursements we can calculate now. We've calculated the amount of payments for direct materials necessary. And for the remainder of these, the expenses were to be paid in the same quarter. So we have the labor costs, manufacturing overhead, sales and admin costs, and we have some future assumptions that are going to be made here. So number one is that we have capital expenditures that will be made in the first quarter. That's 1.2 million. We're going to be paying the income tax payment, which is in when you'll see that in the calculation for our income statement, how high the tax payment is, income tax. And finally, a dividend payment of 1.5 million, which will be made in Q2. So now moving on with the cash budget, we have the assumption that we're going to want to maintain a minimum balance of 50,000 and a maximum of 100,000 before paying down any interest or debt. We have an initial debt of 1 million to start the year, and the interest is being paid at a 5% annual percentage rate, not compounded. So we have money borrowing. Whenever we will borrow money, we're going to assume that it'll happen at the beginning of the quarter and it's going to be paid at the end of the quarter. So the cash receipts we calculated from Q1 were 2.45 million. The disbursements were 2.321, and that gives us an availability of 228,000. That is above the 100,000 that we have, so we can pay down some debt. We have to pay, of course, also the interest on the debt because it's existing at the beginning of the quarter. So we will be paying back 115,000 in principal, and the interest we calculate as 1 million times 5% times 3 months out of the 12, but that's 12,500, and so that gives us an ending balance of 100,000, which is our desirable maximum before paying off some debt. The balance at the end of the month is going to equal the balance at the beginning of the next quarter. Sorry, it's the next period, in this case a quarter. Now we can do the same thing for Q2 with the collections and the disbursements. And here you'll see that we have a shortfall, so we're short of cash to the extent of 796,000. That means we need to borrow, and we need to maintain, as we assumed here, a cash balance of 50,000. So we're going to borrow 50,000 more than the 796,000, and that means 846. We're going to end with a cash balance of 50,000. Again, that's how we begin the next quarter. We follow the same procedure through Q3 and Q4. In these cases, we have excess cash, so we're going to be paying down the debt. So we're going to end each of those 2 quarters with 100,000 because we have extra cash. And the total, we can see the cash receipts are going to, the collections are going to just be the sum, and same will be with the disbursements. And there we have our final cash availability of 726,000 at the end of the year. And we'll see that the borrowing is just a sum of those. So we have the 846. The principal repayments is again the sum, as is the interest. And that gives us our final amount, which is 100,000. Now we can work on the income statement. We have the sales. We have the 5% allowance for uncollectible receivables. We have the net sales, cost of goods sold. That gives us our gross margin. Then we can calculate the sales, general, and administrative costs, not including the depreciation, which I'm just keeping out for clarity. The depreciation is there. Then we have the operating profit of 2.76 million. The interest expense, as we just calculated, that gives us earnings before tax and a tax rate of 20%. That 539 went into our cash calculation, and that gives us now a net income of 2.156. With that amount, we can work on the balance sheet. So here we have values for 2018, which were the assumptions going into each of the budgets, the budget sheet. So for example, we had the cash beginning with 100,000, accounts receivable 1.4 million in the collections budget, and going further on down. The same goes with the results for each of those budgets are shown at the end of 2019. The only thing that needs to be considered are the initial paid-in capital and retained earnings. Those numbers, the 1 million and the 539, were assumed for the beginning of the year. And in the case of the retained earnings for the end of the year, we calculate that using the beginning amount, the 539,000. We add the net income, which we just calculated, and we subtract the dividends of 1.5 million that was also assumed in the cash budget. And that gives us the resulting 1.195 million in retained earnings. And if all goes well, as it has here, the balance sheet will balance out with the assets equaling the liabilities and shareholder equity. In this case, I have not added a cash flow sheet. I've done it, I've calculated it, but I invite you to try to do that on the basis of the numbers here. Although we've gone through each of these budgets relatively quickly, it does add up. I just wanted to let you know that. And then thank you for your attention. And although this was a bit of a longer calculation and a longer presentation, hopefully it was very helpful to you.